In just the last couple of days, Super Microcomputer has fallen by almost 15%. And this massive drop in the stock price comes after a Goldman Sachs analyst downgraded the stock and cut their price target. So in this video, we are going to be taking a look at the reasons this analyst downgraded Super Microcomputer, and I'm going to be giving my opinion on whether I think they are valid or not. Thank you guys so much for the continued support on the channel. I really, truly appreciate it. If you want to know the best way to support the channel, it is simply by going down below and dropping a like on the video. It helps promote it and I really do appreciate it. Also, if you want to catch more videos like this one, make sure to subscribe. One thing that is extremely important to me is making sure that I am transparent with you guys about the positions that I hold in the market, especially when we're talking about companies that I hold in my portfolio. Right here is the YouTube portfolio. It's currently sitting at a value of $59,337.87. And overall, today was a terrible day in the market. The change on the day was down 5.4% for this portfolio. We hold Alibaba, Google, Apple, Microsoft, Palantir, PayPal, SoFi, Super Microcomputer, and Visa. If we look across the portfolio, the stocks that were hit the worst were SoFi, Palantir, and Super Microcomputer. Super Microcomputer alone dropped by 10%, with SoFi dropping by 5% and Palantir dropping 6%. What this tells me is that we are in a very risk-off type of market because a lot of people are flooding out of more of these risk-on type of stocks. And this is really something that I expected to happen in 2025. I've been talking about a 10 to at least 15% drawdown in the broader market. I would love to see the market fall by 20% because what that would mean is a lot of these companies going on sale. We even see that with Google. Google is a company that I have been adding very recently. That is the only position currently in the red in this portfolio, and it dropped by 3.5% today. This could be another opportunity to add more shares to my Google position. And part of the reason my portfolio has held up a little bit better than the market, even though we have seen this massive drawdown in the last month or so, is due to the fact that I have two dividend ETFs. I have SCHD and VYM. These two dividend ETFs are providing some support because oftentimes as the market flips from risk on to risk off, a lot of dividend stocks benefit. However, what I hope to do in the back half of this year, if the market continues to drop, is actually sell out of some of these dividend ETFs and pivot that money into more risk on opportunities. Because as the market eventually will recover over the next couple of years, those market opportunities are going to increase more than dividend stocks. And also to capitalize on that, I have a nice cash pile of over $9,000 currently. However, today we are specifically going to be talking about Super Microcomputer. As you saw from my portfolio, I had 200 shares. I also have another 32 shares in a Robinhood portfolio. So the stock being down by 10% in a single trading day is obviously not a good feeling. But if you noticed, my position is still up around 15%. That is due to the fact that I was buying around the start of the year when the stock was trading between $27 and $32 per share. However, right now the stock is in a little bit of hot water because a Goldman Sachs analyst cut their rating from a neutral position to a sell position, as well as cut their price target from $40 per share to $32 per share. And Goldman Sachs wrote the following reasons. With the stock trading at a 16 times forward P ratio, we view the risk reward as unfavorable given downside risks on valuation, competition, and gross margins. First off, from this statement, I find it very interesting because really competition and gross margins are basically the same downside risk. So they really aren't listing out three different things because once competition comes into the market, typically what you see is gross margins decrease. You don't really see gross margins decrease without competition coming in. These two things are very interconnected, so it really isn't three reasons why the stock is going to be in trouble. At the end of the day, it's really two. It's valuation and then competition. Those two things they believe are going to affect the stock in a negative way. And they went on to say competition in AI servers is intensifying due in part to less product differentiation following R&D investments from competitors competitors in recognition of a large market opportunity, which likely will pressure SMCI's early market share leadership in AI servers. So basically what Goldman Sachs is saying with this statement is a lot of competitors have come in and actually invested a ton of money into research and development in this area of AI servers. What that has allowed these competitors to do is get their products up to the same level as Supermicrocomputer. And because of this, the competition will really start intensifying because these people can now buy Supermicrocomputer's devices or these competitors' devices and basically end up with the same final product. And ultimately, the reason I say competition and gross margins are very interconnected is because as these competitors come into the market, what they will likely try to do is undercut pricing on Supermicrocomputer to get people to switch away from them. What that will cause Supermicrocomputer to do is drop their prices as well, thus affecting their margins. The question I have for Goldman Sachs though is when will they start talking this way about Nvidia? Because Nvidia, they are still projecting great numbers. For 2026, they're expecting Nvidia to grow their top line revenue by 56%. And then in 2027, they're still expecting them to grow by over 20%, 23.5% top line growth. What this means is this AI data center driven boom, they are still expecting to continue in the future. And if that's the case, won't Supermicrocomputer still capitalize on this potential upside in the market? Right now, Supermicrocomputer has been growing their top line numbers significantly in the last year or so. We saw as of the end of 2024, they were growing their top line by almost 55%. And over the last couple of quarters, they've consistently grown their top line revenue by around 200%. And that's what leads into this next point, because if Supermicrocomputer is growing their top line numbers, yes, if their margins decrease, that is not a good thing for the company. However, if they grow their top line, that top line growth could make up for lost EPS in lower margins. However, Goldman Sachs cut their EPS estimates for 2025, 2026, and 2027. We can see that they are expecting Supermicrocomputer to put up $2.57 in 2025, $3.26 in 2026, and $3.70 in 2027. These are below consensus estimates of $2.63, $3.73, and $4.71. And this is where concerns over valuation start to creep in, because Goldman Sachs is clearly projecting lower growth, and they even had the following to say about Supermicrocomputer's valuation. We expect Supermicrocomputer's valuation premium to server OEM peers like Dell to converge over time on a lack of differentiation in AI server products and risks from customer and supplier concentration. In my opinion, this is a terrible comparison. They are looking at Supermicrocomputer's valuation and comparing it to a company like Dell. Let's take a look at a couple of things with Dell. First off, they have a market capitalization of $67 billion. That is about 3 times more than Supermicrocomputer. The stock has traded very nicely over the last 5 years, up almost 400%. However, over that time period, Dell has finally established profitability. That's why the stock has increased so significantly. And we can see that very clearly looking at their EPS numbers. Back in the middle of 2019, they finally saw a flip to profitability. However, if we zoom in over the last 5 years, their profitability has been basically flat. We can see that back in 2020, they were bringing in a trailing 12-month EPS of $6.03. Here today, it's sitting at $5.65. Even if you take out some of these quarters where they saw massive spikes and just look at the quarterly EPS numbers, in 2020, they were hovering around $1 to $1.50 of EPS per quarter. That is consistent with their numbers today. Supermicrocomputer's trend is just the opposite. 5 years ago, they had barely any EPS. On a quarterly basis, it was around 5 cents. On a trailing 12-month basis, it was around 15 cents. We can see today their trailing 12-month EPS is sitting at $2 $2.32. And on a quarterly basis, they are consistently bringing in around 50 cents. And this is very similar for top line numbers. Here we have Dell's top line revenue numbers. Their trailing 12-month revenue is sitting at almost $94 billion. If we go 5 years ago, their trailing 12-month revenue was sitting around $92 billion. So very little growth over the last 5 years. And again, going back to Supermicro, it is just the opposite. Their trailing 12-month revenue is sitting just under $21 billion. If we go 5 years ago, it was sitting around $3 billion. They have seen massive growth in just the last couple of years for their top line numbers. And the reason this growth is so important, or the lack thereof growth for Dell, is because that determines valuation. Supermicro currently has a forward P ratio of 11.14. For a company growing as fast as they are, even if we see that growth slow down to 20, maybe 25% for top line numbers, and then 10 to 15% for bottom line numbers, those are still massive growth numbers that would typically have a stock trading at a valuation of at least a 20 to a 25 forward PE. And here's the thing, if Goldman Sachs is right and Supermicro puts up very weak numbers over the next 3 years and their valuation compresses to around a 10, then yes, the stock is probably overvalued right now. You could see that these would result in prices anywhere from $25 to $37 over the next 3 years. However, I think there are a lot of question marks as to whether those two things could actually happen. I do think competition could come into the market, and that could reduce some of their earnings. However, because AI is projected to grow so much over the next few years, I think that we should still see strong top line growth from Supermicro. That should result in higher valuations. If we want to be on the low end of those high valuations, I think a 15 to a 20 forward P ratio is easily reasonable for this company. That could result in prices anywhere from $38 to $51 in 2025, or $48 to $65 in 2026, or $55 to $74 in 2027. In my opinion, comparing Supermicro to Dell would be like comparing Nvidia to Intel. These are two companies that are in very different time periods of their life cycle. One has very fast growth while the other has much slower growth. That's why for me, I don't plan to sell out of my position in Supermicro. Maybe I'll reduce it if the stock were to run up to $50 or $60 per share. However, even if it falls down, I think it's unlikely whether I would add more to my position. I'm very comfortable with where it's at, and we'll kind of see how it plays out over the next year or so. But as I always say, don't buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below and subscribe for more videos like this one. And as always, have a wonderful rest of your day. And for the joke of the day, how do trees get on the internet? Check the comments down below for the answer. Thanks for watching.